Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is July 15th, 2025, and we're diving into the latest earnings report from Kestra Medical Technologies, a leader in wearable medical devices and digital healthcare. Joining us is John, our senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Kestra's latest report is quite impressive, especially with their significant revenue growth and improved margins. I'm excited to break it down with you.
Revenue and profitability overview. Let's start with the top line. Kestra reported a Q4 revenue of $17.2 million, marking a 71% increase from the previous year. For the full fiscal year 2025, revenue reached $59.8 million, up 115% from FY24. John, what are the key drivers behind this growth?
The growth is primarily driven by increased demand for their Assure system, which saw a 43% rise in prescriptions in Q4. Additionally, Kestra has successfully expanded its customer base and improved its revenue cycle management, contributing to this impressive revenue surge.
And what about profitability?
Kestra's gross margin has seen a remarkable improvement, reaching 44.3% in Q4, up from 13.9% the previous year. For FY25, the gross margin was 40.5%, a significant leap from just 1.3% in FY24. This is largely due to volume leverage and a higher mix of in-network patients.
Operational efficiencies and future outlook. Looking ahead, Kestra has initiated a revenue guidance of $85 million for fiscal year 2026, which represents a 42% increase over FY25. John, how does the company plan to achieve this growth?
Kestra is focusing on expanding its market presence and enhancing its revenue cycle capabilities. CEO Brian Webster highlighted their commitment to innovation and market leadership, which will be crucial in driving future growth. The company is also investing in its commercial organization to support this expansion.
It sounds like they're setting ambitious targets. What did the CEO have to say about their performance and future prospects?
Brian Webster expressed confidence in their strategic direction, noting the strong finish to FY25 and the positive reception of their Assure system. He emphasized the company's dedication to innovation and supporting both prescribers and patients, which he believes will drive market expansion.
EPS forecast and analyst expectations. Now let's discuss the earnings per share. Analysts had forecasted an EPS of minus 54 cents based on a survey of 5 analysts. However, Kestra reported an adjusted EPS of 2.1 for Q4. John, what does this discrepancy tell us?
The actual EPS was significantly lower than expected, which reflects the high operating expenses, particularly due to share-based compensation and IPO-related costs. Despite the revenue growth, these expenses have impacted their bottom line, resulting in a net loss of $51.1 million for the quarter.
How should investors interpret this?
While the EPS miss might be concerning, it's important to consider the context. The increased expenses are tied to strategic investments and one-time IPO costs. Investors should focus on the company's strong revenue growth and margin improvements, which indicate a positive long-term trajectory.
Key takeaways. In summary, Kestra Medical Technologies has delivered impressive revenue growth and margin improvements, despite missing EPS expectations. With a strong revenue guidance for FY26, the company is poised for continued expansion. John, any final thoughts?
Kestra's strategic investments and focus on innovation are setting a solid foundation for future growth. While the EPS miss is notable, the overall financial health and market potential remains strong. Investors should keep an eye on their execution in the coming quarters.
Thank you, John, for your insights, and thank you to our viewers for tuning in. If you found this analysis helpful, please like, share, and subscribe to Smart Stock Watch. We'd love to hear your thoughts on Kestra's performance in the comments below. Until next time,